Bridging loans are marketed as a simple, elegant solution to a timing problem. You need to buy before you can sell, or you need to complete quickly, or you need short-term funds while longer-term financing is arranged. The bridging lender steps in, charges a monthly interest rate rather than an annual one, and gives you the money you need on the understanding that you'll repay it, typically within 12 months. That's the version of bridging that works. There's another version, and it's considerably more common than the marketing materials suggest, where the exit strategy the borrower relied on fails to materialize on schedule, the monthly interest compounds without the borrower fully grasping the rate at which the debt is growing, and what was supposed to be a short-term bridge becomes a months-long, sometimes years-long expensive trap that consumes equity, damages credit, and in the worst cases ends in the forced sale of the property it was used to finance. In the next few minutes, I'm going to walk you through exactly how the bridging loan trap closes, the specific scenarios where it most commonly goes wrong, and what to check before taking one on. I've been tracking the UK property market for years, and bridging finance is one of the areas where the gap between how the product is presented and how it actually performs for a meaningful minority of borrowers is largest. Let's get into it. It's worth naming who uses bridging finance, because the product spans a wider range of borrowers than most people assume. At one end, experienced property developers and investors use it routinely as a calculated, well-understood tool, modeling the cost precisely and maintaining the financial resilience to absorb delays. At the other end, first-time developers, homeowners in timing crunches, and buyers at property auctions are using a product they've encountered for the first time, in a transaction that's already moving quickly, with an incomplete understanding of what happens if the exit takes longer than planned. It's predominantly in that second group that the bridging trap closes most painfully. Before going through the specific failure scenarios, it's worth being precise about the cost of bridging finance in a way that most borrowers don't fully internalize before they commit. Bridging loans are priced in monthly interest rates, typically between 0.5 and 1.5% per month, depending on the lender, the loan-to-value ratio, and the borrower's risk profile. At 1% per month, that's 12% per year, which is already considerably more expensive than almost any standard mortgage product. But the number that matters isn't the monthly rate in isolation. It's the monthly rate compounded over the number of months the loan actually runs, because bridging interest is frequently rolled up into the loan rather than paid monthly, meaning the interest itself accrues interest. A bridging loan of £200,000 at 1% per month, running for 12 months with rolled-up interest, doesn't cost £24,000 in interest. It costs considerably more, because each month's interest is added to the balance before the next month's interest is calculated. Borrowers who compare the monthly rate to their mortgage rate without accounting for compounding and without modeling the specific worst-case scenario of the loan running longer than planned are underestimating the true cost of the product they're taking on. There's also a specific psychological effect worth naming. Because the interest is rolled up rather than paid monthly in most bridging arrangements, the borrower doesn't feel the cost in the same way they would with a monthly payment. The debt grows invisibly in the background while the borrower is focused on the transaction, and the full size of the liability only becomes visible at the point of repayment, which is precisely when the borrower is least able to absorb a surprise. Failure scenario number 1, the exit property sale that takes longer than expected. The most common bridging use case is also the most common failure scenario, a buyer who needs to complete a purchase before their existing property is sold. The bridging lender advances funds, the purchase completes, and the borrower then expects to sell their existing property within a few months, repay the bridge, and refinance the new property onto a standard mortgage. When the existing property sale takes 6 months instead of 3, or when a sale falls through and the property needs to be relisted, the bridge runs considerably longer than the original plan. Every additional month the bridge runs costs the borrower the monthly interest rate on an increasingly large balance if interest is being rolled up, and the total cost of the extra months can easily exceed the annual cost of a standard mortgage in absolute terms. The borrower who assumed the bridge would run for 3 months and planned their finances accordingly often hasn't modeled what happens if it runs for 8. And the lender, having already advanced the funds, has limited practical incentive to help the borrower find a faster exit, since the interest accruing on the loan is the lender's return, and a longer bridge is in the lender's commercial interest, even when it's clearly not in the borrower's.
Failure scenario number 2, the refurbishment project that goes over time and budget. Bridging loans are frequently used to finance property acquisitions that need significant refurbishment before they can be mortgaged or sold. The logic is buy with bridging, refurbish, then refinance onto a standard buy-to-let or residential mortgage or sell for a profit. When the refurbishment takes longer than expected, which is extremely common in construction, when the costs exceed the original budget, which is equally common, or when the completed property value is lower than the developer expected and the refinancing doesn't work at the loan-to-value ratio anticipated, the bridge extends and the financial mathematics of the project deteriorate significantly. A development project that was marginally profitable at a 3-month bridge becomes loss-making at 7 months, and the borrower who committed to the project on optimistic timeline and cost assumptions discovers the margin has evaporated into bridging interest. The specific trap here is that the further the project progresses, the harder it becomes to abandon, because the sunk costs in refurbishment work already completed mean walking away becomes financially worse than finishing, even if finishing at a loss. The borrower presses on, the bridge extends, and the final outcome is a completed property whose sale proceeds don't cover the combined cost of purchase, refurbishment, and accumulated bridging interest. Failure scenario number 3, the auction purchase where the longer-term financing doesn't come through. Auction properties must typically be paid for within 28 days of the hammer falling, which makes bridging finance the natural tool for buyers who don't have the cash available immediately and plan to refinance onto a standard mortgage once they own the property. The trap closes when the property that seemed mortgageable at the viewing turns out not to be because of a structural issue identified in a post-purchase survey, because the lender applies a more conservative valuation than the hammer price, or because the property has a legal defect that the buyer's solicitor identifies after purchase but that the mortgage lender is unwilling to lend against until resolved. The bridging borrower is now paying a high monthly rate on a property they own outright but can't get a standard mortgage against, with no clear timeline for the issue that's blocking refinancing to be resolved. Auction buyers face a specific additional pressure in this scenario. They've already paid a 10% deposit on the day of the auction, non-refundable, which creates a financial commitment to completing the purchase regardless of what the subsequent due diligence reveals, and the speed of the post-auction timeline means there's rarely enough time to identify potential financing obstacles before the 28-day completion deadline has already committed the buyer to a purchase they can't refinance conventionally.
Failure scenario number 4, the developer who can't sell the completed units at the anticipated price. Developers who use bridging finance to fund speculative residential development, expecting to sell the completed units at a price that comfortably covers the build cost, the bridging interest, and their profit margin, are exposed to significant risk when market conditions change between the date the loan was drawn and the date the units are completed and marketed. A development that made commercial sense at bridging inception, when unit values were being projected based on the prevailing market, may make considerably less sense 6 or 12 months later if local demand has softened, if comparable properties are selling below the anticipated price, or if the absorption rate for new units in the area is slower than expected. Each additional month the bridge runs while units fail to sell at the anticipated pace adds significant cost to the project and reduces the final return towards zero or beyond. Now, here's what connects all 4 of these failure scenarios and why bridging traps close faster than borrowers expect. Bridging finance is specifically designed and marketed for optimistic scenarios. The product exists to enable transactions that wouldn't otherwise be possible on a specific timeline, and the marketing therefore emphasizes the enabling aspect, the speed, the flexibility, the ability to complete a deal that would otherwise be missed. What's underemphasized is the specific financial consequence of the enabling scenario not working as planned, because the bridging lender's commercial interest is in making the loan, not in ensuring the borrower has fully modeled the downside risk. The borrower's solicitor reviews the loan documentation and confirms the legal terms are as agreed. The borrower's financial advisor, where one is involved at all, may or may not have specifically modeled the worst-case cost scenario. And the borrower themselves is typically focused on making the primary transaction work rather than on the detailed arithmetic of what happens if the exit takes longer than planned. Here's what nobody puts together properly. The borrowers most likely to end up in a bridging trap are the ones with the most optimistic exit strategies, precisely because optimism about the exit is what makes the bridging cost look manageable. A borrower who genuinely believes their property will sell in 3 months calculates their bridging cost at 3 months of interest and concludes the deal works. A borrower who honestly modeled a 6 or 8 month worst case might reach a different conclusion. The product's commercial success depends on borrowers not conducting that worst-case analysis rigorously before signing, and a speed at which bridging transactions move, designed to capitalize on time-sensitive opportunities, actively discourages the kind of careful financial modeling that would reveal the worst-case scenario clearly. There's also a broker incentive dimension worth being honest about. Bridging brokers typically earn commission from the lender on placement of a loan, which means their commercial interest in completing the transaction may not be perfectly aligned with the borrower's interest in understanding fully whether they should complete it at all.
Here's how this plays out for borrowers who get into a bridge without adequate planning. They draw down the loan, the primary transaction completes, and they begin the exit process with confidence. As weeks stretch into months and the exit fails to materialize as quickly as planned, they discover that the compound interest mechanics are working against them faster than they understood, that their equity cushion is eroding month by month, and that their options for addressing the problem are limited by the fact that they're already committed to a high-cost loan they can't easily exit without completing the transaction that justified taking it in the first place. Here's how this plays out for borrowers who plan properly. Before drawing any bridging loan, they model the cost specifically for a worst-case scenario where the exit takes twice as long as they expected to, and they confirm that the transaction still makes financial sense under that scenario. They verify that the exit strategy they're relying on, the sale of the existing property, the refinancing onto a standard mortgage, the sale of development units, is realistic and achievable under market conditions as they currently stand, not as they stood when the idea was conceived. And they confirm with their solicitor and their broker that the specific property and transaction they're funding with the bridge doesn't have any characteristic that would prevent a straightforward exit, such as a property type that's difficult to mortgage conventionally or a title issue that would delay refinancing. Here's how this plays out at the wider market level. The bridging market has grown significantly in the UK over the past decade, driven by the same combination of a competitive property market and a slow conveyancing system that creates genuine timing gaps bridging was designed to fill. Expect the volume of problematic bridging situations to grow alongside the market, particularly in the refurbishment and development segment where optimistic project assumptions are most common, and expect the specialist bridging lender market to face increasing scrutiny as the number of borrowers who end up in extended, expensive bridges grows. The regulatory oversight of bridging finance is less comprehensive than for standard mortgages, which means the responsibility for understanding the product, its costs, and its failure modes sits primarily with the borrower rather than with any regulatory framework designed to ensure they're adequately protected. As the bridging market has matured, some lenders have improved their pre-lending information and borrower guidance, but the fundamental product design, a short-term loan with rolled-up interest and an exit strategy that depends on the borrower's own actions and market conditions, remains one where the borrower's sophistication and planning is the primary protection against the trap closing on them.
If you're considering a bridging loan for any purpose, the 3 questions to answer before committing are: what does the total cost look like if the exit takes twice as long as I expect? Is the exit strategy I'm relying on genuinely reliable or just plausible? And is there any characteristic of this property or transaction that could prevent or significantly delay the exit? If the answer to the first question makes the transaction unacceptable, if the answer to the second reveals genuine uncertainty, or if the answer to the third raises a flag, the bridge may not be the right tool for this particular problem, and the alternative to taking it on is not necessarily missing the opportunity. It may be restructuring the transaction so that it doesn't depend on a form of finance whose failure mode is specifically expensive. The borrowers who use bridging well are the ones for whom it genuinely is the only practical tool for a specific situation, who understand the worst-case cost precisely before committing, and who have a robust, reliable exit strategy with genuine contingencies in place if the primary exit is delayed. The borrowers who end up trapped are the ones who used it because it was available and the opportunity was time-sensitive, without working through what happens if things don't go exactly as planned.